Of course, FFIUL provides a federal income
All right,
tax-free death benefit.
start it again because I got to record.
Like many things, life insurance has evolved a lot over the past decade. To understand just how far, start by considering this simple question. What do life insurance and smartphones have in common? Remember when phones only made calls? And taking pictures, listening to music, or watching TV each required a separate device? You needed different devices for different tasks, making things more complicated and costly. Today, nearly everyone leaves home with a camera, stereo, internet browser, and flashlight in their pocket, all in the form of apps on their phone. Life insurance has undergone a similar transformation. It traditionally offered little more than a death benefit. If you wanted coverage to help address the financial risk of a chronic or critical illness, or to lighten the burden of funeral planning, you had to purchase multiple insurance policies, making protecting your family and financial future more complicated and costly. Now imagine Index Universal Life has features like apps to a phone, customizable to meet your needs. Introducing Transamerica Financial Foundation IUL, a multi-purpose life insurance policy for your multifaceted life. Let's start with the core features you get right out of the box. Of course, FFIUL provides a federal income tax-free death benefit for your loved ones if the unthinkable occurs. It also offers the upside potential of index account options with the potential to grow tax-deferred policy value, downside protection that ensures index accounts are never credited with negative interest, and access to policy value through tax-free loans and withdrawals. But that's not all. You can choose from many features to fit your needs, like living benefit riders to help protect your quality of life in the event of an unexpected qualifying illness, concierge funeral planning services on qualifying policies, and more. With the FFIUL from Transamerica, design a life insurance policy with riders customized to meet your needs in today's financial landscape. You may not check your policy every day like your phone, but rest assured, Transamerica brings 150 years of life insurance experience and will be there to protect your family when you need it most. Ask your financial professional today about the versatility of Transamerica Financial Foundation IUL.
Okay, how many years? How many years did you guys hear?
150.
150 years old. So, like I said, if you are here today, it's because you have an idea what is an IUL. You heard about an IUL, and I'm going to show you guys because numbers do not lie. And why is it that we are so, and I think I see Usha on. I want Usha to share if she can, I'm putting her on the spot. If you can, Usha. Yesterday we had an important meeting with someone who is very, very, very successful. He has been named top 30 under 30 in Forbes magazine, right? Really, really big deal because this person he's a young guy. He's younger than all of us. Very young guy. And has been listed as the top 30 wealth builder or financial advisor in the country. Top 30 under 30. Top 30 in the country under 30 years old. For the first time in my career, being in this business for 6 years, there was nothing that I could have offered this guy. Nothing. He had his ducks in a row and it was stacked up really, really, really high. So once we realized that this guy is really like, he's where we want to be. He's 30 years old and he is so knowledgeable. He's so smart. He has multiple businesses. He is a multi-millionaire. The mindset is so different. And he said, you know what, Odetta, Usha? Even though I have all that I have amassed, I still go to work every day like I'm broke. I still go to work every day like I'm broke. I put in 110 hours. So here we are, we got on this Zoom thinking this is someone that, you know, we can, oops, I just realized I wasn't even seeing myself. So thanks for letting me know, Kai. Here we are thinking that we could help this guy and probably get him to do the business because he's already in the financial space and he has all his licenses. And there was nothing. There was nothing. There was nothing we could help him with. There was nothing that we could tell him as far as a financial strategy. He had it all. He had it all. And he's doing exactly what we're doing, educating and teaching and showing people how to become wealthy, tax-free wealthy. So, you know, I had to ask him about IUL because if he's top 30 in the country and he's under 30, he's clearly doing something well. So I had to ask him, I said, have you ever heard about IUL, Index Universal Life? And what do you guys think he said? What do you guys think he said? He knew about it. He knew about it. Usha, are you able to speak? If not, I'll go ahead and mention it. Usha, are you able to speak? Okay, probably not. So I asked him about IUL. Because listen, guys, when I meet wealthy people, or when I meet people who are stone cold wealthy, like I want to know, don't you guys want to know? Don't you want to know, like, what is it? What have they done? Yes, we know what they do business, but as a financial professional, you should be asking people, what is it you're doing or have you done with your finance that has gotten you to where you are? That's where everybody wants to be for the most part. Everybody wants to have financial freedom. He's 30 years old, top 30, under 30, 30 years old, 30 years old. So when I asked him about IUL, he said, of course it's better. I have multiple IULs. I have multiple IULs. I said, wow, tell me about it. Tell me about it, right? Because I wanted to hear him spin it. I wanted to learn from him. I wanted to hear how he talks about IUL. He said, in fact, you know what? All of my kids have IUL. I put 25 grand per year, 25,000 per year in my kids' IUL. And he tried to increase it to 100,000 per year. But because they're kids, their limitation on how much money you could put in an IUL for kids. As long as they're juvenile, these insurance company, they don't want you putting too much money in there because they already know it's all this tax-free money. So for him, IUL is a tax-free strategy that everybody, if they can afford, should have as part of their financial house. When he told me he's putting 25,000 a year and he tried to increase it to 100,000 per year for each child, but because the kids are little, he got to wait until they're 18. He wants to put more money. Can you imagine that? 25,000 a year. That's over $1,000. Actually, over $2,000 a month. 25,000 divided by 12 months. Somebody put it in the chat. What is 25,000 divided by 12 months? Put it in the chat. $25,000 divided by 12 months. Okay, guys, I need some participation. Thank you, Kai. $2,083. This is a multimillionaire. He's putting $2,083 a month for his little kids who are not even 8 years old. his little kids. And that's just one strategy that they have. Just one. He's doing so many things. That's just one strategy. Imagine a 5-year-old. Their parents are putting $2,083 a month in an IUL for a 5-year-old and an 8-year-old. 5-year-old, $2,000. Not $150, $200, $300, $500, $2,000 a month. And the crazy part is he wanted to put $100,000 per year. He wanted to put $100,000 per year into these plans because he gets it. He gets it, right? But because they're so young and they're little, they're minors, they're juvenile, insurance company limits us on how much we can put on our kids. I say that to say, he's in the Forbes magazine, 30-year-old in the top 30. And he's helping families with these same strategies and more when it comes to their finances. So if you're thinking, well, I don't know, but this IUL thing, the wealthy people know all about it. And the wealthy people are stacking it because they know it's a tax-free haven. And it's risk-free money. You will never lose your money when the market go down. And you never have to worry about paying taxes in the future. Those two moves alone puts you in a good position. You don't have to worry about taxes in the future. It's a game changer. You don't have to worry about losing money. Guys, I speak to people almost every day. And a week does not go by where somebody's telling me, oh, that I lost money, or that I lost so much money, or that I lost little money, or that I lost money. I don't know if I'm going to be on track for my retirement. I may have to work longer. I may have to get a second job. I may have to get a hybrid retirement. I got to keep working because they save, but they did not save in the right vehicle. And they also lost money. They also lost money. So I'm going to show you, we're going to do things a little different tonight. I like to switch it up. This is why you got to keep coming so you can keep learning. So do you guys want to see the IUL illustration or 401k numbers? Because we're going to stack it up side by side. IUL or 401k, which one do you guys want to see first? And let's go through. Somebody put in $22,500, which is the max you can contribute in your 401k, $22,500. And we put that same $22,500 in an IUL. So let's get started. I see you guys are saying 401k, which is awesome. So guys, this is a calculator that is public. This is not anything to do with our company. This is on the web or any 401k calculator. You can Google it, right? So we're starting with, we put 22,500 annual contribution. Let's say we're not getting any match. Let's say we don't have a balance. We're just starting from zero, right? We save 22,500 every month. Every year. And we do that for about 20 years. So let's say we started late, because these young people, they're not thinking about saving money. They're not thinking about retirement, right? And that's one of the mistakes that most of us, or probably all of us, has made, right? When we were in our 20s and 30s, we weren't thinking about retirement. But that's the time we all should have been stocking away money, even if it's $100 or $150 or $200. That's like an account. We should have been putting money aside and don't even think about it. Just put it away and forget it. But we all made a mistake. None of us did this when we were in our 20s and 30s. We did other things, right? But let's say we just say, you know what? I don't really know about this retirement stuff. I don't know if I'm going to live for retirement, but I'm just going to put $100 aside or $200 aside from now for 20 years. So we put 22,500 Let's say we're 45 because we started late, because in our 20s and 30s, we were living YOLO. We weren't thinking about these things. We were doing other things, right? We were buying houses, cars, traveling, going to dinner, vacation, all the fabulous things, building a life, having babies, raising kids, putting them through college. So we weren't thinking about these things. So let's say we're a late starter. We started now saving at age 45 for retirement. And we're socking away $22,500 every year for 20 years. 45 and 20 is 65. Now we're 65-year-old, we're ready for retirement. So you see here, we have the 22,005. We have 20 years to retire, which means we're saving for 20 years. The average stock market return is anywhere between 7 to 9%. I'm going very, very, very conservative with both strategies. So let's say 7%. This means our money would have grown to almost $1,986,000. You may want to write the numbers down so you could stay abreast, right? So we saved $22,500 for 20 years because we started late in our 40s. So this is why when people tell me, oh, Dara, I'm in my 40s. I mean, what do I do? Well, you still got to save, but you want to save more, right? Because you got less years. But the little kids, they could take their sweet old time and put away $100 because they got more than 20 years to retire, right? So we got almost $1 million, 986. Now this bottom part here is where the 4% rule comes in, where they tell us live off of 4% of your retirement income. So let's say this 986, we take out 4% every year to live off of, and we're 65, right? So we're going to say for 35 years in retirement, we're going to make provision to have money for that 35 years, which will take us to age 100. If we die before age 100, well, some money going to leave behind for whoever, right? But at least we're going to cater for until age 100. Guys, most people born today will live until age 100, right? Things are getting better, modern medicine, technology, people are health conscious, AI coming in, right? So things are changing. So we cater to have money until age 100. So that's 35 years in retirement. Now, here's the caveat. I'm putting a 22%, which again is very, very, very conservative, right? I'm going with today's tax rate on someone making anywhere between 44 to 99,000. So I'm not even showing what the future tax rate is. I'm going with today's tax rate, which let me ask you guys a question. 35 years or even 20 years from now, do you guys think tax will remain the same? 20 years from now, do you think taxes will go up or is it going to come down? Put it in the chat. Do you think taxes will go up or down in 20 years? Yes, all indications shows tax will go up. And if you tell somebody that and they said, I don't think so, that you're wrong. Well, pull up the debt clock. That's it. Just pull up the debt clock. Every one of you should have this debt clock. usdebtclock.org. Just pull it up. Just pull up this website. Again, this is public information. This has nothing to do with our firm. This is public information. usdebtclock.org. Do we see a lot of green or do we see a lot of red? Which one do we see more? Do we see more red or more green? Red or green? Red or green? Which one is dominated? Which one is dominating? Do we see a lot of red or do we see a lot of green? We see a lot of red. And what does red mean? Red is not good. Red is debt. It tells you right there. That's the debt. That's the debt. The country as a whole is in debt. We have like 10 times the debt than how much revenue we're taking in. We're taking in 4 trillion. Our debt is 32 trillion. So all forms of taxes has to increase because we got more debt than money coming in. So I love when people say, well, I don't know. I think you're wrong. Listen, I don't know who's right, who's wrong, but I'm showing you the data. I'm showing you the data, okay? And this is what the data is showing now. Unless the government does something miraculous, I don't know how all these red is going to go away and we're going to get more green, but common sense shows we're going to have to find more revenue. And how do we find more revenue? We increase taxes. So again, this is the US debt clock, right? I didn't make it up. We're just showing you the proof. So I'm going, and again, I'm going with today's tax rate, not 20 years from now, today's tax rate. Somebody making 44 to 90,000, 22%. We calculate. So in retirement, we're going to take out 50,000. 22% taxes will be 11,000 we pay to Uncle Sam in tax, which means we're going to be netting 39,000. People, in 20 years, can you retire comfortably with a 39,000, let's say 40, with a 40,000 annual income in 20 years? In 20 years, can you retire with 40,000? No. Even if you live in the boondocks area of the US. Now, if you go to Guyana or Jamaica or the West Indies, yes, you're going to be comfortable with 40,000 a year. Very comfortable. You're going to live like a king and a queen in a palace, especially if you got your house and your house is paid off in the islands. You live in large. And now I see why a lot of older West Indian people are going back home, or they're doing hybrid retirement. They're spending a lot of their winters in Guyana or the Caribbean, and then they spend their summers in the US, and they're really downsized. They might be living with their kids for those couple of months, and then they go back to Guyana for the majority of their months. And so their money is lasting them a lot longer, right? So again, I'm going with today's tax rate. We know the tax rate are going to go up, but we're looking at almost 40,000, and this is somebody maxing out their retirement, put in 22,500. Now, the next thing I will say is most people need to have at least 4 sources of income. 4 sources of income. The more sources you have is better for you. So let's say you got your 401k income, you got your Social Security income, you got some rental property income, you got like a pension. It is recommended because we know, and they're telling us, that's why they say you got to have multiple sources of income. You want to have multiple sources of income because one is not going to be enough. One is not even enough right now, right? One is not even enough right now. So what do you think 20 years from now when cost of living would have gone up? So now we're looking at 39,659. That's your retirement from your 401k, right? So that is that. Now let's compare the same 22,500 with an IUL, right? We put the same numbers. Everything remains the same with an IUL. So let's share the screen to show you guys an IUL. And then you tell me which one is best. Now, here's the IUL, right? From day one, that 22,500, if you do it for the whole year or you break that down into 12 months, from day one, the first time you make your monthly premium. So if you break down this 22,500 into 12 months, the first premium that you pay, day one, you're covered with 461,000 life insurance. Day one. Is that a big deal or what? Put it in the chat. Because you're putting the same 22,500, break it down by 12 months from day one in a 401k. And what are we getting? What are we getting from day one when we put that money in the 401k? What are we getting? I need you guys to participate, put in the chat. I want to know, when you put that same 22,500, or if you divide it into 12 months, you put that in your 401k from day one, what are you getting? What are you getting, people? What are we getting from day one? 22,500 from day one in a 401k. What are you getting from day one? Thomas said 22,500 and fees, right? Okay, nothing. We're just getting the 22,500. And if you want to take it out, well, taxes for sure, because you're under 59, and penalty, you get it less. Guys, you are going to get less than you put in, because number one, if you try to take it back out, you got penalty because you're under age 59 and a half, and now you got taxes. You're not getting anything more, you're getting less, right? Whereas from day one, you put that same 22,500, the first premium you make. So if you break this down into 12 months, that first 1,000 and change, day one, you are covered with 461,000 life insurance coverage. So if you drop dead the next day, your family gets 461,000 day one. Whereas your 401k, you drop dead the next day, your family gets, minus the taxes and penalty, back your 22,500 minus. So guys, do you see from day one, you're getting more bang for your buck? Put a yes in the comment if you see already from day one, you're getting more bang for your buck. You're getting more bang for your buck, right? It's not about saving people, it's about saving smart. And a lot of people don't know this information, right? When people say that I'm saving, that's good. But I want to know where you're saving. Let's talk about saving smart. Now, you see it says here, additional policy benefits. Also, now we have a provision if we get sick, terminal illness, chronic illness, critical illness. And you might be saying, well, that I'm good, I'm healthy. We're all healthy. We're all healthy until something happens. And I was in a webinar yesterday, I think, and the guy said, hope for the best, but prepare for the worst. This is why you get life insurance. You hope for the best, but you prepare for the worst. God forbid, nobody wants to get sick. Nobody wants to get sick. Nobody think of getting into a car accident or their house being, burned down, or the fire caves, the roof caving. You hope for the best and you prepare for the worst. So I want to stick a pin on this living benefit piece, because I want you guys to see that this is real. Nobody's going to say, okay, we're going to get sick in the future.
I'm a single mother of an 18.
But we want to prepare just in case if life throws us a curveball. So here is a video with Tasha McCray. Hear her story.
And I work in the banking industry.
I'm David Sutherland from Jacksonville, Florida, and I'm a living benefit life insurance agent. When I had first met Latasha, 30 years old, single mother with an 8-year-old son.
I am an avid gym goer. I was really in great health. Dave came over one afternoon.
She explained that, what she was trying to accomplish was to protect her 8-year-old son in case something happened.
The idea that I liked the most about the living benefits, it gave me security to let me know that if anything happened to me, my son would still be taken care of.
What we ended up doing was a 30-year term policy for $250,000 with all the benefits included.
So I decided to put the policy in place with Dave. Years had gone by, and I'm just working every day, going to work, not thinking anything of it. And one day I get a phone call from my doctor. And they called to let me know that I was diagnosed with stage 2-3 breast cancer. It was one of the worst calls in my life. I literally thought I was like losing everything that I had always worked for. I had always been in great health. I had all these financial plans set. And just to hear that, it just made me feel like I was losing everything. I went into shock for about 2 days. I didn't eat. I couldn't really sleep. My doctors were basically some of the best doctors that we had, and they put a plan together how we were going to beat cancer. So it began with telling me the financial needs, of course, the surgeries that I would need. The funding itself was astronomical. My job was kind enough to say, well, we'll give you time off, but it will be unpaid. Therefore, I really didn't have any income coming in to take care of my mortgage, to take care of my son. My insurance didn't cover 100% of my chemotherapy, and I couldn't afford it. I had stocks, I had savings, but it was nothing compared to the money that I would need to take care of the chemotherapy.
She happened to call and say, I need to cancel my plan. I have a health crisis, and I've been diagnosed with breast cancer. And I said, well, no, you don't need to cancel your plan to try and save premium. You need to put in a claim.
Through my job, I had great health insurance. I always thought that because I had great health insurance, I was always covered. Chemotherapy wasn't covered 100% with my insurance. So the living benefit really came in and helped me take care of those chemo treatments, my radiation, my surgeries, my biopsies. There's a lot of things associated with cancer that the insurance companies do not cover.
That's what gets people in trouble financially. And that's why you have a plan with living benefits that you don't have to die to use your plan.
I really didn't have income coming in to put gas in my car, to pay my car note. And I remember speaking with my doctors, and they told me this financial plan was going to cost thousands. One of the first plans that I received was $20,000.
The claims process took 2 to 3 weeks at the most. And then Latasha called me one day and just said, hey, I just got a check in the mail today for just a little over $65,000. She still has almost $170,000 of remaining benefit that's still existing.
Even though I was still fighting cancer, I still had surgeries I still had to recover from, financially, I didn't have to fight through anything because the living benefits plan was there. I just wanted to make sure that my son didn't feel that his mom was sick. He knew I was sick. You know, it was something that I was living through. I didn't want it to affect him at all. He still had his cable, still had his games. And I know to a lot of people that's not important, but to me, it was important for me to feel like I'm fighting this, not he's fighting this cancer. Through a total of 9 surgeries, and 2 years later, I've been cancer-free, 2 years December, and my life has like taken a total turn for the best.
She's back to living a normal life. And it's just a very rewarding, fulfilling thing to have been a small part of that.
The living benefit plan is something that everybody needs to look into, to spare just a few moments of your time, whether it's $30, $40, $50 a month. This is your future that you're thinking about. A lot of people say, I love my kids. If you love your kids, think about your kids' future. Think about your future with your kids, and think about your kids' future without you. If you're not thinking about all of these things, then you're really not planning for a future at all. And the living benefits plan basically makes sure that your kids are taken care of, you're taken care of, your illness is taken care of. Money isn't everything, but when you're battling cancer, it's a whole lot off of you.
Wow. Guys, that video gets me every time. Every time it gets me.
My name is Latasha McCray.
It gets me every time. I don't know if you guys caught it, but she got the plan in the beginning with the mindset of if something happened to her, meaning if God forbid she were to pass away, her son would be okay financially. So she got the policy thinking, okay, if I die, my son is going to be okay financially. She never thought, what if I get sick and I'm alive? She didn't think that. In fact, she was so like that never even came to her mind, because you heard what the guy said. After she got ill, she called him to cancel the policy. So she was not even aware that, oh my God, now I got sick. Let me call this guy to see if I can accelerate my living benefit. She got the plan with the sole mindset of, if I die, my son is going to be okay. But it ended up turning out that she was going to be the one okay financially. You don't want to be sick and broke. We don't want to be sick and still have to worry about the bills. How are we going to get the best care? This is America, people. Depending on the insurance you have, that's the level of care you're going to get for the most part. I'll say that again. Depending on the insurance you have, that's going to dictate the level of care you're going to get. Why do you think when you go to the hospital, the first thing they ask you is what type of insurance you have? What kind of insurance you got? What kind? Depending on which kind, they're going to love you. And depending on which type you have, they're going to give you the runaround. I've seen it with my very own eyes, right? So living benefit is a big deal. Prepare, expect the best, but prepare for the worst. It may never happen. My first condo I bought, it had a pool. I don't know to swim, but I wanted it just to have access to it. So in the event I ever learned to swim, I already got a pool. So another feature from day one, you have all of these benefits. They're living benefits, because if we ever get sick, God forbid, and it's a major illness that alters your day-to-day functions, let's talk about that. Let's see how much money we have coming to us now, right? Protection for if you become ill. So from day one, you have a death benefit, of course. If we pass away day one, 461 pays out, because that's the death benefit that we're covered for. Day one. Day one. That's peace of mind. Day one. Now, this column D that shows the maximum accelerated payout. Look at these numbers. Do you think most people have these numbers saved up anywhere? Do you think people have $1 million saved anywhere, or 189,000 saved anywhere, or 711,000 saved somewhere, that God forbid if they ever get sick, they got money to purchase the best medication, the best doctor, the best facility? Put it in the chat. Do you think that most people have these kind of numbers saved up for provision in case they ever get sick? Cancer, heart attack, stroke, the big ones. Do we have these type of money? Do we have 711,000 saved somewhere that we could just put our hands on? What do you guys think? Yes or no? And by the way, this is just on a payout on 461,000. Imagine if your policy face amount is bigger. The bigger the death benefit, the bigger the payout. This is why you don't want small policies. You don't want small policies, because we don't know what's going to happen 5, 10, 15, 20, 30, 40, 50 years from now, right? So you're also getting another benefit, living benefit only, God forbid, hopefully we never get into a car accident or nothing major, knock on wood. But let's compare this with the 401k. If we get sick at our job, oh, well, she just said it in the video. She just said it in the video. Latasha just said it in the video. Her job said, hey, you know what? We're going to give you time off, but we can't pay you, honey. We're sorry that you got this cancer. We're going to give you the time off, but we cannot pay you. So if she had a 401k, obviously that's going to go real quick. You heard her story, guys. Everything that she had was not enough. Her savings was not enough. Whatever income she had put aside was not enough. It was not enough. So this is another benefit compared to the 401k, living benefits, right? Now, this is a snapshot showing, again, we saved $22,500 just like the 401k. We did this for 20 years, just like the 401k. But here's where it gets interesting. Look at our payout. Annual tax-free income for 35 years. Does anybody remember how much was the 401k number? Let me pull up the slide, the website again, and show you if you forgot. What was the 401k number? What was the 401k number? Right? It was a whopping $39,659 take home after tax versus IUL, $50,000. So not only that you got more tax-free income in retirement, 39 versus 50, but I just showed you all the other benefits even before getting to retirement years. So we would have contributed $450, but we end up taking out in total for that 35 years in retirement, we would have end up taking out 1.7 million. $1.7 million. At the end of the day, we're taking home more money. And guess what? Let's go to the years. Let's look at the tabular details, right? Let's go to the tabular details. So you see at age 46, so all here we see 22,500, right? You guys are seeing the premium outlay. We're putting 22,500 for 20 years, right? So we put in 450. It grows to 793, which is the cash surrender value, the second to last column. And then you see here, we're taking out 50,176. So we take this all the way to year, to age 100. Age 100. Age 100. We cover money for the whole retirement. And again, if we died sooner than age 100, it just means we leave more money behind. We left more money behind if we pass away before age 100. But we make provision for age 100. So here's where the legacy part comes in. I'm showing you this based on 401k contribution, 22,500. This person, when they die, if they die at age 100, look at the death benefit. They'll leave 147,000 behind. If they die sooner, let's say they die at age 90, they leave over $500,000 behind. If they die at, let's say, in our 80s, right? Somebody told me yesterday their grandmother died in their 80s. So, you know, I don't know, like maybe that's something that they're probably thinking they're probably going to die in their 80s and 90s too, right? So if this person died in their 80s, 85, they leave behind 658,000. Guys, let's talk about legacy now. I open up this video with the legacy video. God forbid, when we pass away, do you think somebody's going to remember you if you leave them something? I mean, they may remember us regardless, right? If we're a good person, they're going to remember us regardless. They're going to remember us, right? I remember my granny, right? She didn't leave me anything. I remember my granddad. He didn't leave me anything, but they were good to me. They were good to me. But what if somebody left you, they were good to you, but they also left you something? Would you remember them? Would you talk about them? Would you tell your kids about them? If somebody had left all of us 100,000, how would that have helped you? Think about it. If somebody in your bloodline had left 100,000, they didn't know you were coming. You weren't even born yet. But they made provision and they said, you know what, in my family, I'm going to leave something for the next generation, even though they're not born yet. I'm going to set up a legacy so that every child that borns in my family, after I'm long gone, for 3 generations, every new person that's born, I want to give them 100,000 out of the King's Legacy estate. Now, hopefully everybody don't go out and have a whole bunch of babies, right? Because they want to get this money. Hopefully they don't think like that. Well, what would that do for you when you had turned 18 or 25 and they said, hey, you know what? You don't know your great-great-great-great-great-grandpa Williams, or you don't know your great-great-great-great-great-grandma Kai, or you don't know your great-great-great-grandmother Barbara, but she set up something for you and now you're 25 or now you're 30, we want to give it to you. 100,000, 200,000. What would that do to you guys? How would that have changed your life if you had that leg up? You probably could have paid off a student loan. You probably could have started a business. You probably could have put some down on a down payment on a house. It would have helped you, right? Do you guys think it would have helped you or it wouldn't have changed your life? Talk to me, people. Would that have helped you change your life? Made you have life a little easier, right? Of course. Of course. So although a 401k is great, an IUL is greater. A 401k is great, but an IUL is greater because you're getting so much more bang for your buck and you're leaving a legacy. So I'm going to challenge you. There's a lot of information out here, but get in touch with the person who invited you so we can run numbers based on your needs and see if you qualify for an IUL, because not everybody could get an IUL. I can't give it to you. The person who invited you can't give it to you. We all have to apply. And I'm proud to say I have 3 IULs and I don't have any kids. So as the guy said in the video, even if you don't have kids, don't you want to leave a legacy? Don't you want your nieces and nephews to talk about you or have a life a little easier for them and their kids? Or maybe you're someone that's involved in the community and you want to give back to the church. You want to give back to a recreational building. You want to have your name on, I don't know, on the street, you know, something that lets people know that this person was a great person. Although they didn't know us, they put something in place for us. So get in touch with the person who invited you. The next Wednesday is going to be our final installment of 401k versus IUL. And I'm going to switch it up every week. I'm going to switch it up. It's never going to be the same style every week This is why you want to come back, and you want to come back with friends, right? So our last installment next Wednesday, 401k versus IUL. And for the whole month of September is Life Insurance Awareness Month. Every Wednesday in September, we're going to be tackling life insurance. We're going to go over every week. We're going to have a special focus on each type of life insurance because there's different types and most people don't know what they have. So every week is going to be a specific focus on a specific type of life insurance. So if you have a life insurance, again, also get in touch with the person who invited you so we can review what you have. Do you have death insurance or you have life insurance? Do you have the most modern, updated, upgraded type of life insurance that pays you while you're alive? Or you got the type that only pays other people when you are dead? I don't know about you, but I don't have 3 policies to pay everything to them and nothing for me. It's about me first, right? It's about me first. And it should be about you first. So if your policy is not about you first, well, I mean, it's okay because each strategy is for different strategy for different folks. But I challenge you because most people who have a life insurance, they don't really know what they have. Somebody sold it to them and all they know they're paying for something. They don't know if they have enough coverage, right? They don't know if it has living benefits. They don't know if it has cash value. They don't know. Or maybe they got a plan that was great, but they got it 20, 30 years ago and times have changed. They got it when they had no kids and now they have kids. They got it when they had no house and now they have a house. Get in touch with the person who invited you so we could do a complimentary review of your existing policy. So all month of September, I'm challenging you. If you have a life insurance, if you know somebody that have a life insurance, or just flat out say, hey, this month is Life Insurance Awareness Month. And I would just want to ask you, do you have life insurance? You got one? Great. Let's set up a one-on-one to review your plan. After all, September's Life Insurance Awareness Month, right? So every Wednesday, we're going to be right here, 7 p.m. And if you live in the New York area, we also are going to be in the streets, right? We're going to be at 3 libraries in Brooklyn, September 16th, September 23rd, and on September 30th. 3 Saturdays, back to back, every Saturday, the last 3 Saturdays in September. You guys that are on this Zoom, you're going to get the recording. You're also going to get the links to register for the seminars if you live in New York and you want to come out. Or if you're not in New York and you want to join us on Zoom on Wednesday, you can do that. But for those who are in New York, we might be live streaming. I'm not sure, but definitely all I will say is information without implementation is a waste. Don't hear this stuff and just go back to doing what you're doing. Call us when we hang up. Call us and say, hey, Odetta, hey, Thomas, hey, Ochi, hey, Barbara, hey, Rhonda. You know, I want to know more information. I want to have a one-on-one. I want to go over my strategy. I want to talk about my 401k. I want to go over my 403b. Call us. We are here to help you. We don't want you to spend money. We want you to save your money smart and get more bang for your buck. Why? Because strategies like an IUL not only helps you, but it's positioned to help your generation. Because you, my friend, are the one for your family. You're responsible. That's why you're on this Zoom. You're responsible with your finance. You want to learn more about your money. But you're not selfish because whatever you're doing for yourself and sitting with one of us and putting in place a strategy like an IUL, you're not a selfish person. You're not only thinking about yourself, but you're thinking about your loved ones. Because ultimately, when we all go to heaven, whatever we've done for us or put in place for us, it's going to go to somebody that you love because you get to put the name of people on your IUL as a beneficiary. You get to put your grandson name. You get to put your granddaughter name. You get to put your kid's name. You get to put your husband name. You get to give that gift to someone tax-free and build a legacy for the next generation. So with that being said, I could go on and on and on. I love this business. Thank you guys so much for joining us. We will be back here, like I said, next week, Wednesday, August 30th. Same thing, 401k versus IUL, but we put in a spin on it. We put in a twist on it, right? So again, get in touch with the person who invited you. If I invited you or you've seen my posts on social, Instagram, Facebook, WhatsApp, YouTube, wherever, actually, I'm going to put my link right now in the chat, odetaking.com, stack your coins. Go ahead and book your consultation. If you, like I said, if you are already talking with someone who invited you and they're one of us, go back to that person and say, hey, I need a one-on-one. I want to talk about my strategy. Help me, right? Guys, you have nothing to lose. Nothing to lose. Nothing. Become educated, protect your money, grow your money, and help yourself first. These strategies about you first. All right. So thank you guys and make it a great evening. Take care.
Their score was so jacked up, and when they saw the report, they realized that mama had gave out their social security number to the whole family. And everybody done rented stuff and didn't pay back, and everybody had electric bills and cell phones that don't even exist no more. Why? Because somebody didn't care about legacy, and they handed you a bill, and now you can't walk in Canaan, not because of your issues, but because of some issues that were passed down. God forbid you are sitting in this place saying, I don't care about legacy. You need to care about it. Because somebody's got to live in the life you have. You are passing something down whether you want to or not.